Good morning. Today is Friday, March 6th at 10 a.m. And I'm recording this because we are planning a major change in the portfolio. And I wanted to get this information out to you because it is time sensitive. If you haven't noticed, volatility is back in the market. We launched a war against Iran over the past weekend, and that sent the stock prices up and down with concerns about the high prices of energy. But that's not the only risk in the economy. For a while now, we've been talking about the risks of interest rate uncertainty. We've been talking about the risks of higher inflation down the road, and we've been talking about the risks of a slowing economy. So for all those reasons, over the past month, my team and I have been working on the right strategy to help reduce the volatility in your portfolio and take a little bit of risk off the table. Now, before I get into the strategy, I want to put into context where we are in the cycle. The last bear market that we had was the 2022 bear market. Went from about January 2022 ending in October of 2022. So this bull market, this upward moving market, is about 3.5 years old, starting in October of 2022 to date. And your portfolios have done very, very well during that 3.5 year bull market run. We have had 3.5 years of above average returns in the portfolio. Okay. And so we feel like it's a prudent time in the cycle to begin to take some of that risk off the table because we feel like it's inevitable that with above average returns, the below average returns have to eventually come. And we feel like by protecting the portfolio now, we can help protect you from some of those possible coming below average returns. Now, let me be clear. We are not predicting a bear market this year. We're not predicting a recession this year. In fact, I actually think the most likely outcome still is continued growth this year. But the probability that we have a down market this year has dramatically increased. I would say from a year ago, I would have said 15 to 20% probability of a down market this year. Now we're closer to 35 to 40%. And it's that dramatic increase in the probability that we might have a downward moving market that makes us feel like it's prudent to take a little bit of risk off the table. So what are we planning on doing? We're going back to one of our tried and true strategies, the structured note. But this is a new, evolved, better structure than we've ever used before, and we're really excited about it. Now, the details of the structured note are in the email that you've received with this video. But just to kind of put it in context, we want to move about 15% of your portfolio, mostly, but not entirely, out of stocks and into this 2 year structured note strategy. We want to do it in two tranches. One 10% tranche now with an optional additional 5% tranche in the coming months. We can do that sooner if we feel like it makes sense to do it sooner. We can do it later if we feel like it makes sense to do it later, or we can do it not at all if things dramatically improve. Now, we're not doing this across the board for everybody. Okay. We have different portfolios based on what your goals are for your money. And if you're in our income or our growth in income portfolio, it is our strong recommendation that we think this structured note strategy makes sense for you. But just in case you don't think it makes sense for you, we are giving those clients who are in our income or growth and income strategy the option to opt out. Okay. If you choose to opt out, we'll leave the portfolio the same and we'll just ride out whatever is coming. Okay. If you do nothing, we will implement the structured note portfolio in strategy in your portfolio for those clients in our growth and income or our income portfolios. On the flip side, if you're a client who's still in their working years, okay, in the accumulation phase of life, or has a bucket of money with us that has a longer time horizon, you're probably in our growth or our aggressive growth portfolio. For those clients, we are not recommending the structured note strategy, but we are making it available for you to opt in. Okay. Portfolios with a longer time horizon don't necessarily need to protect against short-term market swings. You can take a little bit longer risk, accept higher volatility in exchange for a higher return. And so we don't feel like it's necessary to reduce the volatility in those portfolios with longer time horizons, those clients with a growth or aggressive growth portfolio. But if you are concerned about the market, if you are worried about the volatility, and if you think reducing that volatility is right for you, we are giving you the option to opt in. So again, this requires action on your part. If you have a growth or aggressive growth portfolio for us and you would like to participate in the structured note strategy, you must contact us to opt into the strategy. Okay. All right. Um, if you have questions about whether this strategy is right for you, if you want to talk about any tax consequences, okay, please use the link in the email to schedule a quick call with myself or my team so that we can quickly address your questions, your concerns, and decide whether this strategy is right for you. But again, time is of the essence. The essence of the way the structured note works is it does have a deadline when we have to trade into it. So we do need to hear from you very quickly. And some of the information about the deadlines is in the email. So please reach out to us. Don't hesitate. We're here to help if you have questions. And other than that, I look forward to our conversation very soon and take care.